Social Security benefits headed for the largest increase in over 40 years. We're going to be joined this morning by our fellow certified financial fiduciary, also happens to be one of our national Social Security advisors, Rob Field, of part of the team at Nelson Financial Planning. Also, we're going to be asking some important questions of what you need to be thinking about, or perhaps asking yourself as you prepare and get closer to retirement. More importantly, we're going to sort of summarize three key takeaways that are important for you to be thinking about. So welcome to the program. This course, Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. To my left is one of those certified financial fiduciaries at Nelson Financial Planning. Good morning, Rob. How are you?
Good morning, Joel. I'm doing good. Good to be here. Always like the opportunity to chat with our listeners about Social Security.
That you are passionate about that, and we love the passion because it certainly is a pretty important topic and a very big part of, unfortunately, a lot of folks' retirement income depend on that. I think you've got some stats on that, if I recall.
Mm-hmm. We've got, just off the top of my head, I'll tell you that for Social Security, people that are on Social Security, 50% of those, that makes up over half their income.
Wow.
And then for 20% of the seniors, that's actually 90% of the income they make comes just from Social Security.
That's incredible. That is just incredible. So obviously, here on the program, we're going to be talking about the potential COLA adjustment for next year. For a lot of those folks, it means a tremendous amount. So we're going to be talking about that later on in the program. Wanted to take this first segment and sort of recap something that we were talking about last week, and that is this IRS apparent crackdown on charitable contributions. If you joined us last week on the program, we told you the story about a taxpayer who had made a donation of American Indian artifacts to a museum out in New Mexico, and rightfully so, had taken a pretty significant deduction on their tax return, only to find themselves in tax court and ultimately having the deduction be disallowed, all because the recipient entity did not properly give her a receipt with what some are referring to as the magical language that has to be on your receipt from a charitable organization. That language says something to the effect of that you did not receive any goods or services in exchange for this gift. In that particular case that we were talking about at length last week on the program, the museum didn't have that sentence in there. What was even surprising about how this case turned out is the museum quickly tried to fix it and said, well, yeah, we didn't give her anything in exchange for this. But the IRS took the position that it did not follow the letter of the law, if you will, and ultimately prevailed in tax court over this taxpayer. So make sure you are clear when you get those receipts that it has that magical language, whether or not you receive goods or services in return for the donation. The other piece of it is that has to be contemporaneous and in writing, meaning at the time you gave the donation, you can't go back after the fact and get that. So with that backdrop, one of the things that we talked about was it might be good to sort of recap for our listening audience some of the rules involving charitable contributions. So we'll divide it into cash donations versus property donation. So if you'd make a cash donation, and by that we mean not just $100 bill, but writing a check for $100, the reality is that if it's below $250, you probably just need some form of proof. The reality is that the requirements to take that deduction can be satisfied by having a bank record or a check or some kind of notation, some kind of written evidence of the amount that you gave, the date that you gave it, and the charity to which you gave it. For those donations that are under $250, you don't actually technically need a receipt, although, again, best practice, you probably want to grab that is for sure. Now, as those cash donations get above $250, well, that's where the requirements get much, much tighter. So in that particular case, you need a statement from the charity giving the amount of the donation and whether or not those goods or services were received in exchange for goods and services that the charity provided. So you need sort of that magical language again on anything above $250. Now remember, these are individual gifts, so you don't need to aggregate. So let's say you do $50 a week to your church, the aggregation rules wouldn't necessarily apply, but bottom line, always good to have that printed receipt and the charity's acknowledgement. And remember the magic language that these receipts now have to have, and that is whether or not you receive goods or services in return for that donation. No pens, mugs, cups, stuff like that doesn't count, token items, but the reality is it still needs to have that statement on it. So that's the cash side of it. Bottom line on that, make sure you've got the proper paperwork. Make sure you've dotted the I's and crossed the T's, because the IRS is looking at that, particularly with this tax case now on the books in its favor. The IRS is going to be looking at this much more closely. And as we were talking about last week, certainly with the extra money that they've been given, the reality is that these are the kinds of things that they're going to be looking at much more closely. So that's cash. Shift over to property donations. So that would be your trips to Goodwill, where you donate your old stuff, things like that. The reality is that you do need to have the name of the charity, the donation site, and an item's description. If it's between $250 and $500, then you typically will need a written statement from the charity in hand, again, saying that magic language. And because the reality is only the amount in excess of what you got in exchange is actually a charitable deduction. That makes sense, right? If you got something back that's worth $100 and you gave them $250, well, then yeah, you're only allowed to write off $150. For donations, property donations exceeding $500, that's where the rules kind of continue to shift a little bit more, where you're going to need a much greater documentation in terms of that donation. If you're going property above $5,000, well then in that particular case you probably need some type of a qualified appraisal. So we just want to take a moment in this opening segment and just sort of recap those rules involving charitable contributions as they now stand. Bottom line, documentation is key. It must be contemporaneous and it must have that written explanation that you did not get anything in return. Also, some deduction limits to certainly observe anytime you make a charitable contribution, and those deduction limits depend on whether you gave cash, whether you gave appreciated securities, or whether you gave property. Depending upon which category that falls in, it'll determine how much of that charitable contribution you're able to write off, and also how much of that you can then carry forward. So just be aware that as you give these gifts, particularly these larger gifts, there are a whole nother set of rules that determine how much of it you get to write off based upon your total income and also based upon the nature of the gift. Now, the good news is that any excess amount you can carry forward for up to 5 years. But again, document, that is for sure. So those are the current rules to be aware of regarding charities and charitable deductions. With that, we're going to take a break and then shift gears. When we get back from the break, we're going to be engaging in conversation with Rob a little bit more than we did in this segment, and talk a lot about Social Security in the impending increase in those Social Security checks. Coming up next here on Dollars and Cents with Joel Garrison, Rob Field of Nelson Financial Planning. Social Security about to have its largest increase in over 40 years, increases that are projected to be even larger than the 5.9% that folks experience this year. We're joined by Rob Field, a fellow certified financial fiduciary at Nelson Financial Planning, also our resident national Social Security advisor. Good morning again, Rob.
Good morning, Joel. Good to be here.
There's certainly some interesting stats you shared in the last segment about the percentage of folks that rely on Social Security for, in essence, the majority of their income. Half of the folks out there rely on it for the majority of their income, 50% or more. So certainly this adjustment is going to be pretty important for a lot of Americans. So what's the predictions? What's the tea leaves, if you will, saying to you on this one, Rob?
The numbers are kind of they've been changing month by month, and so a lot of things are affecting that we'll get into in a second. But we are at that time of year where we start really evaluating what has inflation done to the cost of items that everybody uses, but particularly how would it affect Social Security. And so they're taking a look at these numbers, they compare them to similar numbers and the changes they might have made a year ago, and then they apply what they call the cost of living adjustment to Social Security.
Sure.
We did this show last year. We're excited. 5.9 was a pretty good, healthy number at
After
the time.
A number of years of basically nothing.
Right. We saw some years of
was
ones and less than ones, and we saw zeros, and really was 40 years ago was when we saw something in the sevens. Since then, it's been pretty low, and we know inflation is growing a lot higher than how that works. So we'll find out probably going into October what the exact number is going to be. But I looked at some different groups that are making their predictions. If you AARP, who's a big advocate of Social Security, they came out in August and they said, we're looking at probably 9%. That number is a little lower than what they had predicted earlier. Newsweek in July was saying 11.4.
Wow. No, that's...
So then I was looking at CNBC. They're pretty good about looking at inflation, coming out with some numbers. In July, they said, we predict it'll be 10.5%. But then in August, they dropped it down to 9.6. A couple of things have changed. We've all experienced the increase in gas prices over the summer. It got pretty high, but it actually dropped down a little bit since what we saw the high of June. It's about 20% lower. That equates into their decision making of what the COLA would be, because transportation is a big factor, not only the consumer price index for the workers, but the CPI for the elderly, which we like to use more. And that those changes in gas prices, that carries over to transportation, utilities, the cost of things like that. So the number will be pretty high. It's going to be somewhere between, I would say, 8 and 11. It might not hit 11 if people kind of take into consideration gas prices have come down.
Particularly this notion of the impact that gas price has, right? Because that's a big, the gas price is such a big rippler through the economy. When you think about, when you go into the grocery store, all that stuff didn't just magically show up. It came by virtue of something that was using gas to get it there. So that has a massive ripple effect, if you will, throughout the economy.
No, you're right. The truck brings the food. If the gas prices are higher, it costs more to get it there. You got to pass those. Eventually, you and I are the ones who are paying for the higher prices.
Correct. That's the thing about inflation. It usually winds up in the consumer's lap. So, but it's interesting. There's a couple of different sort of measurements of inflation. So why don't you share with our listeners some of those different measurements of inflation that are out there?
Sure. We typically, when we talk about inflation and we talk about the consumer price index, it's the consumer price index for workers, which is kind of just the general index that looks at the cost of clothes and transportation, medical, housing, things like that. And it's kind of weighted depending on what they think that age group would use.
Sure.
When we look at Social Security, we're talking about a different age group.
That's correct.
And so there is an index called the CPI for the elderly, and it basically is looking at price changes for seniors that age 62 and above. And when you look at the comparison and the different weightings, the first thing you notice is that the cost of medical care for drugs and going to the doctor is about twice as high for the senior as it would be for a normal person. The other thing would be housing. It's typically more expensive for the seniors to house themselves. Throw in assisted living, maybe it's bringing in caregivers. So when they make their decisions based on the CPIW, which is kind of just covers younger people, it's really not accurate in the change of pricing for the elderly.
Well, and I think that's probably the biggest reason why even the increases that we've had, which have been relatively low, absent this year's increase, really haven't allowed seniors to really sort of keep up, right? I mean, there's
Correct.
some interesting stats on just how much that difference in the inflation that the elderly folks experience versus the population as a whole. That's actually pretty dramatic.
Very true. I was looking at an article by the Senior Citizens League. It's a nonpartisan advocacy group that's focusing on the seniors. And they kind of came out and said, since the year 2000, inflation has decreased the purchasing power for seniors by over 40%, which is a much more dramatic number
Sure.
than everybody else. They're making their prediction based on this month of about a 9.6% cost of living adjustment. So even though those numbers might be lower than originally predicted, if we can get close to 10%, that's a nice, helpful jump to get the
Sure.
seniors kind of back online.
Well,
where they should be.
especially if they're 40% behind over the course of the past 20 odd years, they've
Correct.
fallen 40% behind because they are experiencing much higher rate of inflation than certainly the population as a whole. So that's sort of the story on the sort of the COLA side of it. There's one piece that always pops up, and that of course is the Medicare side. Now, last year that had a pretty significant increase, which took a lot of the 5.9% increase away. It went from $148 up to $170 for Medicare Part B, so about a 14.5% increase. What's sort of the tea leaves on that look like? Because that's a big part of whether you actually get to keep your increase in your Social Security.
Right. We've talked about how medical coverage for the seniors seem to be rising faster than everybody else. What's interesting for the price increase that they did for Medicare Part B, which is the doctors, you got Part A is already covered in your Social Security. Part B is about a year ago, 2021, when they were looking at what they thought the cost would be in 2022, they were looking at a new Alzheimer's drug that had come out that was supposed to be extremely popular, but was also going to be very expensive. And so they built that pricing into it. We come a year later, it turned out to be that drug was really not that popular
Wow.
and not that expensive. So not only are the tea leaves saying, things will probably go up a little bit, there might be a credit, might bring it back down a little bit because they technically overcharged, raised it higher than they should have.
Well, that's
So-
interesting. So when they're coming up with that cost, they're kind of trying to predict what the medical needs going forward might be.
Right,
And if you're wrong, then you've overcharged people.
right. And as a tendency, they'd rather be overcharged than undercharged.
I guess
And-
that's how the government works. Yes.
But the push now is like, hey, if you overcharged us last year, don't give us a huge increase in our cost. You're giving us more for the cost of living adjustment, but then you're also increasing our Social Security Part B. Let's consider the fact that maybe you went up too high last year. How about we don't do any increase? But that's
That
my
would be
feeling.
hopeful.
That would be,
and-
yes,
and
that's
it-
what I would like.
At the very least, there is a school of thought out there that would say that maybe your Medicare Part B premium doesn't go up, okay, as at all this year because it went up so much last year.
Correct.
Above and beyond perhaps what it should have. So that's certainly so I guess at the end of the day, it's all of this is sort of as is always, right? A little bit of a good news, bad news conversation. So we will recap of that good news, bad news dichotomy when we return after these messages here on Dollars and Cents with Joel Garrison, Rob Field of Nelson Financial Planning. So talking about the dichotomy that comes with what may very well be the largest increase in Social Security that we've seen in over 40 years. In the last segment of the program, we were talking about some of the data and the details behind how that number gets determined. And certainly we're joined on the program by one of our fellow certified financial fiduciaries at Nelson Financial Planning, Rob Field. He also happens to be our resident National Social Security advisor. Welcome, of course, back to the program, Rob. So in the last segment, we were talking about the potential, I guess you're pegging it that COLA increase somewhere between 8 to 10%, which would be a pretty significant improvement over this year.
Probably something like 8.9. They won't quite give you the 9 like they did last year, but I think that would be an accurate estimate. It'll be a nice catch up. We've talked before about we're still behind, but that range will help.
It certainly will, and the reality is the reason that we don't know exactly what that number is, but we're now starting to get a little bit more of an inkling. Is, as I understand it, it's based upon, is it based July, August, and September data is kind
Correct.
of the 3 months that they really look at, and then they make the formal announcement in October.
Right. They'll go back in last year and say, okay, what happened in the July, August, September time frame? How does that compare to any changes in pricing this year, 2022? Same thing, third quarter. And then as we head into October, they'll take that analysis and then come up with what they think the final cost
numbers
of living adjustment should be.
So it should be interesting. So as we like to say in radio all the time, stay tuned for the final number, if you will. We'll have you certainly back on the program, but certainly more than once between now and then. And I guess as we were talking about, here's the good news, bad news on that, right? So the good news is that as we've been saying, it'll help seniors sort of catch up, if you will. Some estimates, as you were saying, Rob, earlier, put seniors about 40% behind from where they should be because of low COLA adjustments that have been happening over the course of the past 20 years. The bad news is that because of this increase in Social Security and that the threshold for taxation of your Social Security has not changed in probably 35 years and was never indexed to inflation, that threshold, then more and more people are going to find that their Social Security benefits are taxable. At least some of them. For most people, it is all of them, because those thresholds that determine taxation or the inclusion in your income of your Social Security for tax purposes, those thresholds very low and certainly have never changed. And I guess the other bad news is that if Social Security is going to have to pay out the benefit plus 9%, doesn't that accelerate the issue that I guess nobody's willing to really talk about these days in Washington, which is, doesn't that sort of hasten the date of insolvency on that?
That subject comes up a lot. And a couple things to remember is every year, as we also get the cost of living adjustment, they're taxing a higher amount of our income. We've gone from 142 last year, or 142.7 last year, 147 this year. Probably going into 2023, they're going to tax over 150,000, up to 150,000 of your income. That's how they fund it. And there's even talk of doing the donut where 400 grand above would get a little extra. So there's always money coming in. That's part of what Social Security does. We do have a trust fund. It's got a little over $2.5 billion. That number's going down. Thanks to COVID, we've had people retiring earlier. We've had some people who wanted to get a job that couldn't. But as long as there's income and it's being taxed, there's money coming into Social Security. So even if they lost the whole $2.5 billion, which they're doing whatever they can to stop that, they would still be taxing. It would still generate 70 to 80% of what we see currently benefits. A
Right.
reduction, yes, but they can't go bankrupt as long as they're taxing income.
That's the hope. Although based upon the projections, it's never that they'll run out of money. It's just that they may not have enough to pay the full amount of the promised benefit. So
That's true. But you see them, we've gone over the last few years from full retirement age being 65 to 66. Now, if you're born 1960 or above, full retirement age is now 67, which that number, if you're trying to, if you have income coming in, but you haven't hit full retirement age, it's reducing and they'll hold back some. So they're trying to come up with ways to push people to, again, retire later.
right, delay, retire later,
Right.
all of that to try and put the program in good shape. So some interesting things to be thinking about when it comes to Social Security. Welcome, of course, to our listeners to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, coming to you on a host of radio stations throughout the Central Florida region. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out on your favorite podcast platform of choice. If you have problems finding our channel, go to our website, nelsonfinancialplanning.com. Upper right-hand corner, you'll see a bunch of icons. Click on the one that looks most familiar and you'll get automatically connected. When you do, make sure you subscribe to us so that way you can get notified of when we put up new content on those platforms. So, you know, Rob, certainly every day at the office, we talk to people about the notion of retiring. And as folks look ahead to that, I think there's a variety of questions that sort of pop up from, you know, sort of how much you need for monthly expenses. I mean, you're involved in those conversations all the time as well. I mean, there's some normal questions that pop up.
You know, the typical one is, can I retire now? Do I have enough to retire? What do I need to retire? Once I retire, how much income can I generate? And you know, we kind of have to back into what does retirement look like to somebody, and then plan ahead so that you have enough money for it. Or if you're at retirement age and this is what you have, here's the kind of income we think you could generate.
Certainly, that conversation, and that's one of those full conversations that we encourage folks to have on a personal sort of one-on-one basis here in the office, because everybody's situation, to your point, Rob, is unique. There's no two people that are alike. No two retirements are going to be the same, and it certainly does generate a host of questions in terms of, well, how do I get the income? That's often a question, right? If you've been working, you're getting a paycheck, it's direct deposited into the checking account, no issues. How do you do that when you actually retire? How do you cover taxes? All of those kinds of issues that certainly pop up that are all part of that conversation.
Very much, because you know, when people ask us, can I retire today? You could. It depends on what you want to do, how, you know, what your goals are, but you got to have that budget. We've talked about that before. You've got to know what assets do you have, how am I going to tap into them. Social Security will come into play. I like throwing that into the mix because once you know what you're going to get per month from Social Security, you've got that one stable number. Now you can say, okay, I'm going to make up the difference with my 401k. What percent can I take out to generate the income to hit the budget I want? And typically we talk about budgets, and they're usually pretty large the first couple of years when somebody retires, and we have to kind of rein them back in, because our goal is to not wipe out the asset, but to have it continue to be in place, generate income, provide some extra withdrawals if necessary, and hopefully pass, you know, a big piece of it on to the next generation.
Well, and I think that's an important statement, what you just said, which is that I think people think that they're oftentimes, and we hear this all the time, oh, I want to retire, but it's okay. I'm not going to spend as much. And history and a whole host of data on how people spend money say exactly the opposite, particularly in those first few years of retirement when you're younger and you've got the ability to go and do things, and generally going and do stuff takes money.
Right. If you're healthy and you're not spending 8 hours a day going into the office, you're sitting around thinking, well, you know, I've always wanted to improve my golf game, so I'm going to join a golf club, and I'm going to buy some new clubs, and maybe I get my own personal golf cart, and it all seems
it starts to add up pretty
Right.
quickly. But I think at the end of the day, for us and with the conversations that we like to have with folks, it really does boil down to three sort of key takeaways, three pieces that you've really got to dig into on a significant level. And so we're going to get into all of those three key pieces coming up in the next segment. So stay with us during the break. This is Dollars and Cents with Joel Garrison, Rob Field of Nelson Financial Planning. Stay tuned through the break for continued conversation. Before the break, on the program here, Dollars and Cents, where we help you make sense out of all life's decisions involving your dollars, we were talking about some of the questions that come up as people come into the office, Rob, and engage in that conversation, that retirement planning conversation. And, you know, in our minds, it sort of boils down to sort of three, I guess, key pieces. There's probably certainly way more than three, but that's why we encourage folks to come in for a personal conversation, because as we said in the last segment, no two retirements are the same. But I think there's three keys, if you will, that you certainly want to get on the table early on when you're talking about retirement. And I guess what would be sort of the first one, if you will, that pops into your head, Rob?
Well, we always, we know healthcare is going to be an issue once you retire, and you've got to plan on the fact that health expenses are going to be a little bit higher as you go along. Also, where's it going to come from, right? If you're not working, you don't have healthcare at your company, you're on the hook for it yourself. Medicare is available, but if you're trying to retire at age 62, you can't really get Medicare until age 65.
Right. That's a hard age that applies for Medicare, and that's, as we were talking about earlier in the program, one of the reasons why seniors have experienced a much higher rate of inflation is because of how much that cost of healthcare has been going up. So that's always one of the key things that we bring up in those retirement planning conversations is, okay, well, where are you going to get your health? How old are you? Are you eligible for Medicare? And if not, where are you going to get your healthcare from? But just because you're eligible for Medicare, there's still a cost to that.
Well, even that, right? I mean, once you get 65, Medicare will help a lot, but you're still going to have your Part B premium. We know that the cost of drugs gets pretty expensive, so then you got to get creative and say, okay, am I sticking with Medicare? Do I need to look at Medicare Advantage plans? And it's just like shopping for anything else. You got to really kind of compare what something can provide for you, and does that get you your needs? No matter how you slice it, it's going to be expensive.
Sure, no question. And the reality is, it really requires you to do a large amount of homework and diligence to really find that plan that works for you. One of the things that I typically will suggest to folks is it's important to have that conversation with your primary care physician and the specialist that you see, because you want to make sure that whatever the plan is that you're choosing, that it is something that they accept. Because the last thing you want to do when as you're aging is having to switch doctors after years of going to see the same physician, being forced into switching. You certainly don't want to do that. So we think that conversation probably starts more with a conversation with your doctor's office to see what they take and what they don't take. And then I think often overlooked in terms of saving specifically for healthcare are health savings accounts. And sure. I think those are one of the most powerful savings vehicles out there, hands down. But not many people know about health savings accounts, that's for sure.
Well, it's not something that's just on the forefront where people are always constantly talking about it, but it is a way to save. You can get up to $7,300 if you got a married couple, to put that away and then pull it out, with some great tax advantages to cover those expenses, and then it offsets the other expenses that you might have had with the drugs and things like that. So yeah, we don't hear people talk about it a lot, but it does have some great advantages.
Really, it's the only thing that has the triple tax benefits working for it. It's tax deductible, it grows without taxes, and it comes out tax free. I mean, that's the triple play, if you will, and no other account has that except for a health savings account. Now remember, to have that, you have to have a high deductible plan. You have to have the specific health insurance coverage in order to have a health savings account, but certainly something to look into if you've got that proper insurance plan that allows you to do that. Because the beauty of that, and here's where I think people get confused on health savings accounts versus flex plans. The flex plans, you got to use it or lose it by the end of the year.
Right.
Health savings account, that doesn't happen. You get to carry, and the benefit is that you really want to put as much money into it as you can, not only for the tax savings, but for the reality is that you can continue to get tax deferred growth on it. And ultimately, the more you put in, then the more you're able to kind of carry forward to those future years. So certainly something for folks to be thinking about, particularly as they think about kind of that key factor of understanding and looking at healthcare needs. Number two on of the sort of the top three things to really chew on when we're thinking about retirement would be your retirement withdrawals. Not just your retirement withdrawals, but really where your withdrawals are going to come from. Rob, you mentioned earlier in the program, oftentimes Social Security is one part of that. And the taxation of that is dependent upon how much other income you have one way or the other. But depending upon the type of account you're taking money from, there's also different tax implications.
Well, sure. The Social Security, once you start taking it, you know that's going to come into the mix. You're not going to stop that or anything like that. Then you analyze the other investments you have. If you had a 401k and it's now rolled over into your IRA, it's never been taxed. So when you pull money out of that, it's going to be fully taxable. Might have a Roth. Those become very, very popular. You've already paid your taxes. So hitting that too quickly might not necessarily be what you want to do. And you have just your regular investments. You got savings account at the bank. It's probably not in a qualified plan, so that money's already been taxed. We would kind of nudge people towards, let's avoid paying taxes when you can. And
I'm always a fan of that.
Always a fan of that, and our clients seem to appreciate that advice too.
Well, and the reality is, and I think you just touched upon a big issue that folks have to really be thinking about when it comes to creating that income in retirement, figuring out where that money is going to come from, those withdrawals, is it's really imperative that you've got to overlay your tax return over your investments, and you've got to almost really intertwine those. And it's not, I don't think it's enough, particularly with how complicated the tax code is these days. And if you've ever tried to calculate your taxable amount of your Social Security, by hand, good luck on that. You really need your tax software to be generating out these accurate numbers, but to be able to overlay that tax perspective on your investments. I mean, I think that's why, and obviously in other shows we've been joined by Christina of our office, who's an IRS enrolled agent, and Kristen, who is our in-house CPA. We actually do tax preparation, filing of tax forms for our clients at the office at Nelson Financial Planning. And so I really do think that integration really does help folks understand kind of what's the most tax efficient way to be able to utilize my assets to generate out that income in retirement. We're constantly kind of running the what ifs with our tax software to just see what makes sense for really all types of decisions. So I think that's kind of the key thing, the key second takeaway, if you will, is thinking about that retirement, those withdrawals, where they're going to come from. And then lastly, and this one's of course near and dear to your heart, right? The third thing that we always kind of talk through with folks is your area of specialty, Rob.
Sure. Coming back to the Social Security, you've got to integrate that into your plan, whether it's the healthcare side of it and how Social Security and Medicare is going to come into place. We talked about generating income. You want to figure out, okay, if Social Security is in place, if I start it now, how much is it going to be? If I wait, would it be a little bit higher? Is that to my advantage to delay it? And so, again, another coordination. Let us kind of show you what you got. You can start Social Security as early as age 62, but if you're now born in 1960 or farther out, your full retirement age is 67. So that's a 5-year gap. It's about a 30% decrease in your income if you start at 62 versus what you would get at age 67. The flip side also occurs. If you wait till age 70, where you get the maximum benefit, you might increase your monthly benefit by another 32%. So you'd be at 132% of what you could have gotten. You've got to kind of make your decision on, if I don't take Social Security, where am I going to get it from? And that's where we kind of step in and show you your options.
So important to understand that full picture, because if you've got a lot of other assets, that may dictate the decision in terms of Social Security. Anyway, we're going to wrap it on up and get on out of here. Thanks for listening to the program. This has been Dollars and Cents with Joel Garris and Rob Field of Nelson Financial Planning.